Our next guest runs the world's biggest bond fund, and he's here with us now to share his analysis on the financial markets, the economy, the Fed, and what it all means for investors. He's Scott Mather. He's the Chief Investment Officer of Pimco's flagship Total Return Fund. Good to see you again, Scott. Welcome back.
Good evening, Sue. Thanks for having me.
We noted last night how well the Total Return Fund has been performing. You are outpacing your peers by better than 90%, and you've turned that fund around. How did you do it?
Well, I'd like to tell you it's all myself, but it's really not. We have a process here. It's always a large team of people involved in designing the strategies and the individual securities that we're selecting for the fund. So we have 260 portfolio managers, and they're all an integral part of the strategy-making process. So it's really using the same people, the same processes that have allowed us to outperform over numerous market cycles for decades. So we're just returning the fund back to where we normally spend most of our time, which is at the top of the league tables.
Mm-hmm. Indeed. Where did you find the best trades, the best value in the market? Because you've basically been looking all around the globe as well as in the Treasury market. So where did you find the most opportunity?
Well, there's a few important themes. One, we've been very focused on monetary policy divergence. Mm-hmm. That's a theme that there's many different strategy implications, many different things we've been doing in the portfolios to take advantage of that. We do believe, for instance, that the Federal Reserve is going to begin moving interest rates in the summertime, even while other central banks are very actively easing monetary policy. So we've had a number of strategies in place in the portfolio to take advantage of that and to prepare for that. Some of the things that have worked particularly well are a focus on European bonds, which have been outperforming U.S. bonds. Our focus on looking for other areas in the world where monetary policy and rates won't be tied to the U.S. rate cycle, places like Mexico, for instance, for local rates. And of course, there's many other, one of the follow-on themes from this is continued dollar strength, and that has implications not just for the currency positioning, which has worked out well for us, but also for a lot of the individual sectors we're investing in the corporate market.
What about Greece, Scott? Because that seems to be roiling the equity side of the market, and it's sending some money into fixed income on various parts of the U.S. yield curve, but also in Germany as well. And there's a lot of talk, as I'm sure you're well aware, that we may see negative rates in Germany. How big a factor is Greece at this point?
Well, it's an important factor, and obviously today it was one of the main things that was driving markets across the world. Greece is certainly not a very significant portion of the global economy, not even a very significant portion of the European economy, but it is very important. There are all sorts of unknowns about what happens if a country does go down the path of exiting the monetary union. And our base case expectation is that Greece manages to find a way to stay in the monetary union, manages to muddle through this. But with each day that passes, it is certainly getting worse and worse for the Greek economy. It means they're getting deeper and deeper into recessionary territory. They need more money from their Eurozone partners. So, the risks of a disorderly outcome certainly for Greece are rising, and that will have implications for Europe and the global economy through financial market channels and through confidence channels.
You mentioned your forecast for the Fed. We saw the inflation figures come in this morning, and that kind of upset the equity side of things. What about inflation-linked bonds? Is that part of your portfolio? Is that a strategy that you've been employing or not?
Yes, absolutely. Inflation-linked bonds, they started the year very cheap, and so we've had positions to emphasize owning inflation-linked bonds over nominal treasuries, for example. Those positions are beginning to pay off, contributing to performance of the fund. We think there's a lot more room to go, though. The market was very preoccupied as we started the year about disinflation and about the ability of a drop in energy prices to somehow filter in a lasting way. The market was basically pricing that the Fed would fail to meet its policy objective for 10 years or longer. Mm-hmm. So it's a very good opportunity. We think the inflation-linked bonds, although they've bounced and are performing well, they have a lot further to run. As it becomes clearer that inflation is definitely headed up. It's headed up because wages are headed up, and also because the effects of that big drop in energy prices is going to pass and move away from influencing headline inflation. All
right, Scott, we'll leave it there. Continued success. Thank you so much for joining us. Scott Mather with Pimco.